11 a.m. UK time on Friday. Just a quick update. I'm really looking at some of the ideas around market structure. Now we're getting a little bit of a bounce and a little bit of a breather. I wanted to sort of look forward at potentially what might happen next week, or what to look for next week rather than what necessarily would happen. I think what's key in analysing this market is that almost everybody in the market has experience, or a lot of people have experience of the old world prior to 2015, 2014, where active managers and prop desks and hedge funds, active hedge funds were the drivers of the market. Today the market is probably much more rules-based, smart beta-based, passive fund-based, and it's completely different. In fact, we can see that in the fact that we've seen the S&P has dropped 27% from an all-time high in the fastest time ever. It was about 16 trading days. The most similar thing to that was probably the 1987 crash, where we dropped 34% in about 11 trading days. But back then, there was the warning sign. We had a prior warning by a small drop and then a bounce and then the collapse in the market. But that was driven by the sort of beginnings of electronic trading and portfolio hedging. Today, is it those smart beta funds that are in the driving seat? And the reason why this is important is because the rule book would be very, very different. Over the last sort of 4 or 5 years, they've always been buyers. Even into most of the dips, their triggers were still on the buy side. Have those triggers now been switched to the sell side? And yesterday was an interesting day. We talked about the big flows through the market. Clearly it was a liquidation, that's obvious. But the way that it sold off into the close in Europe, sold off into the close in the US, so those were the lows of the day. That was programmed trades, and we could see in the FX market that the dollar rally was completed at 4 o'clock exactly, and then reversed and turned back down again. So that had all the signs that we were seeing a portfolio liquidation. It may well have been smart beta. And the fact that bonds were also trying to sell off into that market weakness as well, yields were coming off their lows, is another indication. Now going forward, next week is an important week, and in the old world I'd have used next week as the week for potential a low to buy into, because it's expiry week. And that's also one of the reasons we're seeing volatility, is that if you've got, as we get towards expiry, there's much more gamma hedging going on from market makers, and people will be playing with their positions. If you think of something 1 month away from expiry, it doesn't need so much hedging as when it gets right into expiry, and then it needs a lot more. That's what we're going to see, that's what's currently happening, but that gamma will roll off by the end of next week, and often by the middle of next week. So if we see a high volume low next week, I think there's a good chance that might be a great opportunity to play. The other thing about market structure as well is in terms of volatility. We've seen the VIX move a lot, very, very high. It's got up to about 77. Realized volatility on the S&P is about 88. So they're in line. Vol is in line with realized vol. So that's kind of fair value. We haven't seen a big explosion in vol yet. It's high, but it's not exploded. The reason why this matters is there's structured products out there where people have sold puts. The big place for that is Korea. It looks like the Koreans have been repatriating capital, so they've already been unwinding, because the Korean won has not been as weak as many of us would have expected given the moves. However, I think we've still got to watch that. 220 on the Kospi is a level we used to always look at from 2010 to 2015. It's held in so far. We got to 2040 on the Kospi 200. That could be a big level. 200 points below the 2018 low on the S&P. That could be a big level where this could then add another 10 to 15 points very quickly to the downside, percentage points, with a big spike in vol from there. So that's not happened, but these are the things to watch for. And then finally, in terms of positions, Europe's obviously been under pressure. If we do see another leg lower, we want to look at what are the winners so far, the ones where there's still opportunity on the downside. And perhaps the standout one for me is the European industrials, the SXNP. If you look at that versus the broad market, it's still near the all-time highs. Now, I can understand why defences would be up there, and in a world where oil's falling, I can understand why chemical stocks might be up there. But for the industrials to be near their all-time highs relative to the market itself, I think that's an opportunity for, if we see another rollover, that could be a great place to look to take profits, or at least find some shorts that might work for you in another leg down.